Okay, so what we're going to do today, guys. Today, we're going to talk about ratio analysis. Last time, we talked about vertical and horizontal analysis. So some of you might ask, so what that makes it different than what does that make it different than what already we have seen last time in the vertical analysis? The vertical analysis for balance sheets, we take every account and divide it by the total assets. It's a ratio, but the ratio is only divided by the same denominator and using different account in the balance sheets. Same we do in the income statement. We take every account and we divide it by the revenue. And that's the way we do vertical analysis for the income statement. What we do in the ratio analysis, we take different accounts from the balance sheets or the income statement. For example, if I want to see how profitable is the company, I might take the net income and divide it by the total equity, how much money the investors had put in the company. And that will be indications how profitable is the company for the investors. And we'll talk about that ratio in a minute. But the basic idea is in the ratios we use some account from the income statement or maybe the statement of cash flow and the balance sheets and the other ones. And we give interpretation to those ratios. They teach us something what happened. And then we can even look at those ratios over time. Okay. One thing that we're going to continue, and we did last time, we will use the application we developed in Academy City to analyze financial statements to different companies. Last time we looked at Apple. And when we looked at Apple, we get all those vertical analysis for Apple, horizontal analysis for Apple. And today we look at the ratios for Apple. Okay. And we extend the discussion using these applications. By the way, this is a working process. We will continue in developing all the corporate valuations. And that will be a lot of other more stuff. Okay. And by the way, this is already a finish, as I said. If you take my course in corporate valuation, you realize you will have to choose the industry, the companies, and then it does the whole calculation of valuation. But that's for a different course and this one has still more to go, and there will be a complete, nice corporate valuation simulation. For now, we'll focus on financial statement analysis, which is quite ready for almost every company. For now, we opened that for 20 companies, but we will extend, we'll put more companies. If you're really interested in a specific company, please feel free to put the name of the company on this recording in the comment, and we will edit. Okay, so our team will add and open it up for the public. We're aiming to really open as many companies as there are, and almost every company traded in the stock exchange in the US, and eventually we'll even expose it to companies worldwide. So back to the discussion first. So what do we have in the ratio analysis? We do different ratios to learn about the company's strength in different areas. And there are 5 major topics in which we focus. One is how liquid is the company. Liquidity is very important for a company, meaning when you have to pay interest, you make sure you have enough cash, okay, and don't have to sell something just to pay the interest. If you have to pay your suppliers on time, make sure you have enough cash. Otherwise, you might destroy your relationship with your suppliers. So the first ratio is taking how much current assets we have relative to our current liabilities. That ratio tells us how much cash could be available immediately to pay the current liabilities. There are situations in which the inventory cannot turn into cash immediately. In those cases, we calculate the quick ratio. In the quick ratio, we remove the inventory from the current assets and we do the same ratio. So let's look at our example we played with last time. Okay, for 2000X1, we take the current assets, which is 30, we divide it by current liabilities, which is 32. This ratio come to about 94, I guess. And if we look down, we see that indeed current ratio is 94. How did we get quick ratio? We simply took the 30 and we subtract from it the inventory 9, we come to 21. 21 divided by 32 give us 66%. Okay, so the current liability 32, 21 total current assets minus the inventory give us 66%. Again, a 66, it's a high number. It's 94 for current ratio is too high or too low. That really depends on the kind of industry the company is there. And as I mentioned, we're going to add another column here, and you can really compare it to the average in the industry. So if most of the companies are around 90%, so this company 94 is okay. But as we go along, we see this company really have a high current ratio. Maybe they have too much cash, and they really should reduce the cash. Some companies, depend on the industry, should have a high current ratio, and some of them should have a lower ratio. Again, depends on the industry. And really, different industries, their relationship with the suppliers is different. The relationship with the bank is different. Paying current liabilities really depends on the industry or the customary in the industry. Okay, that's the first quick one and a quick ratio. Very easy to understand and very easy to calculate. And let's move to the next category. The next category there was debt service ratio. That means is how much debt is the company use to finance its operation. After all, the funding for running the business really come from two sources. Or I'm issuing equity or I'm taking a loan. The loan could be from the bank or could be from the public. As I raise capital by issuing shares and those shareholders become to be the owner of the company, the same I can go to the public and issue bonds. And when I issue bonds, I promise those bondholders the interest they will get on lending money to the company. And on the bond, you will see the interest promised to the bondholders. It's another topic that is usually good to cover. And I really recommend, by the way, for you guys, go and look for other videos on accounting. They go dive into deeper. I mentioned it briefly in the beginning of this series. The objective of this series is to introduce you to special things we do in Academy City, not to really be a comprehensive financial accounting course, but definitely a good summary for you and a good way to jump into this topic, okay? But I really do encourage you to expand your knowledge over time. Go and study more about equity. Go and study more about debt. How do you really value debt? That's in another course, for example, in corporate valuation. So don't stop with this course. This is a good introductory and a good way to expose you to technology as well. So let's move into those examples. First one is debt to total assets. Total assets is the total asset the company is operating. Okay, could be current, could be long-term. How much of that total assets was financed by the owner, which means the equity, and how much of that was financed by the total liabilities. Okay, so if I take total debt divide by total assets, give me some indications how leveraged is the company. Leverage is a word used many times in finance to say how much is being financed by the debt. So if I take total liabilities, okay, 632 divided by 810, I would get the total debt divided by total assets. So in this example, we're getting 78, okay? Some things, if I take total debt divided by the equity, okay, I would get that it's about if I take a total debt divided by the equity, I see that really as a big part of it is really being financed by a by the debt. So really, debt is really much more than equity in this example. It's very easy. You can see that the relationship you can show mathematically easy way. Really one-to-one. The higher will be debt to assets, the higher will be the ratio debt to equity. Because if the debt is higher, I have less equity. So debt to total assets will go up. One more time. If I have more debt in the company, debt to total assets will be higher. But the more debt I have, then I have less equity. So debt to equity would be higher. So they're really one-to-one, but they're presented in two ways. Okay, you will see in finance, and when we get to corporate valuation, really most used is debt to equity. And you can see that it's being used in measuring risk. And what does it mean measuring risk? Why is it really higher risk? The more debt I have, the more interest I will have to pay. Okay, one more time, the more debt I have, the more interest I will have to pay. And what happens if there is a fluctuations in the industry? What happens if there's a bad time? I might get into a point I won't generate enough revenue to pay my interest, and the current assets will not be good enough. Then I might get into trouble. Again, you might see some industries that you can have a lot of debt. For example, if your fluctuations of revenue is very low, meaning you have a stable revenue, then you can allow a higher debt. If your revenue or your net income or income before interest is less fluctuating, it's very stable, then you can allow again to have more debt. But if it's fluctuating a lot, you probably should be careful more, and then you reduce the amount of debt you're financing the company. Okay, we'll see those examples when we talk about Apple and see how Apple, for example, changed their policy relating to debt to equity ratio. For now, this is a very simple divisions of one number by the other one. There's another one, it's called time interest earned. It's a very interesting number. It's a very good one, by the way. Okay, that give me indications of the capability of the company to pay their interest. Remember in the income statement, okay, when we looked at the income statement, and this is a very conventional way to organize the income statement, we have income before taxes, and before it we have earning before interest and taxes. If I take this 260 last time, I call that amount to be my take. It's the amount I can distribute to the parties that involve in running this company or really have interest in this company. Okay, not really running, the word running would be really the right one. But if I look at that, the 260, I'm going to give part of which to the government, part of which will go to the interest, paying the bank for taking the loan, and whatever left will be belong to the equity owners. So, but you know, who is first in line? First in line getting the money from this 260 is the bank. They're the first one I pay the interest. If I didn't have enough money, or I just barely had to pay the interest, then the whole amount would go to the bank. No money would be paid to the government because we don't have any profit. And if I don't pay any taxes, really nothing would be left to the owner of the equity. So really the first one in line are the interest payment to the owner or whoever is giving me really the loan. Okay, so if I'm taking the loan from the bank, the first in line to get money from that operating profit will be the bank. So if I take the amount of 260, okay, and divide it by the interest, I can see a number that tells me how much really I have enough. Do I have enough to pay the interest? So if there would be a fluctuation and my operating income will go down, I still be able to pay. So if the ratio is very high, it means even if the operating profit will go down 1 year or some years, I still will have enough to pay the interest. Okay? Because This is I have to pay. Okay, otherwise I might be in default. So the higher the ratio, the more I know that I can pay my interest. Taxes I don't have to pay if I don't have a profit, and I don't have to pay. By interest, I have to pay. So that ratio is a very, very good indicator of my ability to pay my debt. So that's very common ratio to calculate. And the higher it is, the more sure we are that this company can pay. By the way, if you look at those numbers in the example, we see are really going up. You might even ask yourself, is that too high? Maybe we should take more debt, because we saw last time, we talked about it, the more debt I take, the profitability of the equity owners goes up. And moreover, the more that I take, okay, it's recognized as expense for calculating my taxes. So I would pay less taxes. The company pays less taxes, will have more profit to have distributed to the shareholders. So in this example, it looks like, wow, perfect. The company is getting more secure. But the question is, if it's not too secure, and we should really take advantage of those benefits of financing the company by taking debt. And the answer again, look at how common it is in the industry that we are operating. And by the way, I mentioned that last time, we looked at Apple, and I said we are calculating all those ratios. We're going to add another column at some point in Economy City that we will present all the companies we have in our database in the same industry. We'll calculate the average, and that will give you a good indicator. Does Apple have too high or too low a ratio? Let's just take a pause and really look at Apple in this time. Okay, last time we looked at the horizontal and we looked at the vertical. Okay, and we said from the vertical of the balance sheets, we saw that the cash, okay, percentage wise, okay, is going up as percentage of the total assets. Moreover, we looked at the current assets. We saw that it used to be 33, it became to be 44. Okay, so we can say current assets going up. What happened to the current liabilities? Is the current liabilities went up at the same? If you remember, we mentioned that last time. Okay, so if we look at the current liabilities, it did go up also. What happened to the ratio? The ratio, we look at the ratio analysis. So let's look at the first ratio. Okay, the first ratio is the current, and we do see the current liabilities. The current ratio was about 1.5, fluctuating a little up, went down a little bit, but basically is around 1.3 to 1.5. So the current ratio is quite stable. Is it too high? Is it too low? Again, this is a huge company, as most likely, and it's also quite mature by now. So that's probably the right number for the company. Not really, I shouldn't really make that conclusion immediately, as we'll see in a minute. Okay, but comparing to the industry, companies in the same industry, although Apple is quite outsider in a sense, it's a big company. Okay, and we have to measure it much more carefully than just a simple comparison to the average. But the average is quite a good one most of the time. How about the quick ratio? Quick ratio also 1.48, 2012, fluctuating a little bit, and then it's 1.33. You can see the difference is very small, and that's because Apple don't really have a lot of inventory. Does Apple really have a lot of inventory? No, we can know that by the vertical analysis. Let's look at the vertical analysis of the balance sheets. Okay, let's see how much is the inventory out of the total assets. Very low. You can see it's a very low. So this fact that the inventory is very low, those two ratios will be the same things for Apple. So Apple really doesn't have a lot of inventory. Also, it's a computer company. You would expect a lot of inventory, but it really doesn't have to, because they're selling it to other ones, and other people are selling those computers for the company. Okay. On the other hand, we'll see other companies. We'll look at the Walmart. Let's see how the ratio for Walmart looks like. Totally different company, different type of an industry, and the ratio might be different. And we'll see how that will be different than Apple. Let's look at the debt to total assets. Debt to total assets used to be very low, about 10%. How much is today? 2020, 50%. Well, Apple became to be heavily financed by debt. Didn't used to be. Used to be only 10%. Now it is 50% financed by debt. Wow, we mentioned that last time. Okay. What about the ratio of debt to equity? It used to be very small. Okay, because most of the company was financed by equity. Now it's totally changed, 2.5 times. The debt is 2.5 times the equity. In another word, you can really see half, or debt to total assets half, or debt to equity 2.5. That means only 20% really is financed by equity. Let's look at the balance sheets again, the vertical analysis. Okay, and we look at the balance sheets. Let's look at the total equity. What is the total equity? It's only 20% today of the total assets. How much is the total liabilities? Total liabilities is 80%. So big change. If it used to be only 33% the total liabilities, today total liabilities, it really is 80%. As Apple became to be more risky company, well, on its face it does. Maybe if there will be a crisis, it might get Apple into trouble. Is there something happening here? Most likely there is. And we will explore it more into corporate valuation when we talk about corporate valuation and look at a lot of other aspects of Apple. Then you can really see what's really happening with Apple. By the way, if you check the curve of the stock price of Apple, it's blooming. What is the reason? Is this a good move or a bad move? Is that put Apple maybe getting a jump in the price of Apple, but in the long run might hurt Apple? That's a good question, not for this course, but this is a very good introductory to valuing Apple in more detail in the next series we will do on this topic of valuation. For now, one thing we can say, Apple is getting more leveraged. They are financing more of their stuff by using liabilities than they used to about 9 years ago, 2012 relative to 2020. And that comes immediately when looking at the ratio. You don't even have to jump to the balance sheet, but it definitely, I always recommend to my student, look at the vertical, look at the horizontal, and look at the ratios as well. Okay, so no questions, debt to equity becomes to be much higher for Apple. What about times interest earned? Okay, well, that's very interesting. You can say, well, maybe Apple is not really just jumping and taking risk. It didn't really change much. It used to be, okay, around, no, it did. Sorry, I take it back. It used to be it was negative 1 year, but we can ignore that. And we look at the 2014 up to today. It used to be really high. We had a lot of profit relative to the interest we're paying. Went down, went down, went down. In the last 3 years, it's around 2, meaning they still have twice as much as the interest they need to pay. Is that secure enough? Most likely for a company like Apple, okay? I don't know if for another company, 2 would be good enough. Again, we can compare it to the average in the industry or to companies in the same size as Apple. Most likely, those people have thought about it very deeply. And I believe that's probably appropriate for Apple. But again, I'm careful in my language. I get more detail when I talk about corporate valuation. And that's I examine it from many other aspects. And then you get a better answer about this question. Is 2 is good enough? For now, you can probably assume that it is, okay? But you probably would like to compare it to other big companies in the same industry, okay? Let's get back to the other categories. What are the other categories? The next one is turnover ratios. And again, this one, it's a ratio that tells me how efficient is the company is managing their inventory and managing their customers. The first one tells me how much really credit we give our customers. We're making, let's say, a lot of sales, but maybe we're giving a lot of credit to customers. And that might be a problem in the long run, because maybe some customers will not pay, and they will default on the loan we gave them. And by the way, we're not earning most of the time interest on the credit we give to customers. So giving a credit could increase my sales, but at the same time putting a risk of collecting less, and it could be a burden on my resources of financing the company. And then I might end up going and taking a loan from the bank just because I'm giving a credit to my customers. Again, depends on the industry. Okay, if it's customary to give 30 days credit to customers, then that's really what Apple should do. If it's 60 days or 90 days, okay, that's what you should do. If you are in a different industry, okay, and there's no credit, many times when you go to probably Walmart, it will be really interesting. We'll compare it to Walmart. Does Walmart give a lot of credit to their customers? And that ratio of revenue to the account receivables give me some indication to, do I have to give a lot of credit to make sales, or I manage my customers in such a way that I still sell a lot, but I don't really have to hold or give a credit. Giving credit to others might be that I have to bring that resources to the company another way. So I would like this ratio to be as high as possible. The higher it is, it means that I'm more efficient in managing my customers and increasing my sales, not just because I'm giving credit, just because it's a very good product, just because I have a good marketing strategy, etc., etc. Okay? Now, one point I would like to mention, when you do this calculation, you say this is the first ratio, we're using a number from the income statement in the numerator and a number from the balance sheet. And now you could, and you should ask, well, income statement is something, those accounts in the income statement are numbers that created over the year. What do I mean by that? It's like a duration account. Duration means all my sales happen during the whole year, okay? On the other hand, account receivable, it's a number I see in the balance sheets in the end of the year. I can see account receivables in the beginning of the year. Which one should I use for this ratio? For the sales, total revenue, I have only one number. That's for the year. So I take the revenue for the year from the income statement. Which number should I use in the denominator? And that's why the word average. When I use in those ratios some account from the balance sheet, customary to use the average. The beginning plus the end divided by 2. And that's like the average account receivable during the year. Okay? And you will see the same things we do with inventory. For the inventory, by the way, we use cost of goods sold. That's how much it cost me to generate the revenue. That's the direct cost of generating the revenue. And we compare it to the average inventory we hold in the business. Again, I would like to hold as little inventory as possible. The less inventory I have, the less I have to pay for the warehouse. The less I have to ask for credit from my suppliers. Some of my suppliers might not give me credit, and then I will have to pay immediately. Again, a burden on the company. Okay, so I would like to be efficient in a sense that I will hold as little as possible inventory and give as little credit to my customers. Let's look at Apple again. Okay, by the way, Apple, we know they have very little inventory, so that number will be very high probably. Okay, and really depend on the cost of sales. Let's look at the Apple example and see how their strategy about account receivable. Okay, let's look at the ratio. Account receivable turnover. Well, they're around between 11 to, you can say between 14 to 11. They never really went down to 12, I should really say. They're quite stable, okay, quite high, okay. But if you look at the industry, it's probably the right number, okay. So I can say it's quite stable, the same. What about the inventory turnover? Also, you'll say it's what about 83 one year, but most of the time it's around between, I should say around 40 to around 50. So between 40 to 50 most of the time. But if I will do an average, most likely I will get about 40 or 50, something like that. Okay. There's some years that it's fluctuating more, but most of the time it's around 40 to 50. Again, inventory turnover, it's already a big issue for Apple. Don't forget, it's a high-tech company, very innovative company. It's not the one that actually, they do have their own stores, but and are quite stable in the way they're running their stores and the way they're running their suppliers and running with their distribution channels. So no surprise, those numbers are quite stable. It's a quite mature company. Okay, let's go and we'll see maybe other companies and see how those ratios are fluctuating. Okay, let's look at the other category of ratios. Profitability ratios. Well, bottom line, is the company making profit? And now we saw before, and we talked about it, that really, when we talk about profitability, we should really start from this line of operating profit. Okay, this is a very important number. EBIT, known as an EBIT, earning before interest and taxes. After all, this is the bottom line. How much profit is this company in the bottom line have generated? That will be available to pay interest, that will be available to pay taxes, and at the bottom line, how much profit I'm giving my equity owners. So I might develop few ratios, look at the whole company as a whole, and then look at more specific. How much is really profit I have left to the equity owners, okay? And how much profit I'm making on the total assets. After all, this is available as a profit on total assets. So I will look at this one, I will look at the net income, and let's look at more specific ratios. And we'll see that all of them really make sense. The first one, we already have seen them before, okay? And the second and the last two in these ratios, it's new ones that we'll talk more. The first one came really just from the vertical analysis of the income statement. We take the net profit and we divide by the total revenue. We take the gross profit and divide it by the net sales. Let's look at it again. By the way, in the vertical analysis, they're right there. Let's look at the income statement. I just come from the income statement. I have the revenue for 2001. I take the gross profit divided by the total revenue. That gave me about 20%, okay, or 21%. And if I take the net income divided by the 2000, it tells me bottom line, out of all those revenue, how much is left to be given to the equity owners? And those two ratios, although we saw them again, we usually like to put them in that category. So let's move to the next two ones, okay, which are new ones, okay? Those ones are return on assets, meaning if I look at the net income plus interest expense, or another word, I will look at the operating profit, excluding the taxes I'm paying. In another word, if I go to the income statement and take the 260 for 2001 and subtract only the taxes, okay, I will have about 235. That will be available to two partners. I always like to call them investors or partners in a sense, that both of them contributed money to finance the company. One gave it as a way of ownership and one gave it as a loan. The 235 it's for those two together. So if you take the total assets or the total financing we got, that's what they're going to get back together. So when I take the return on assets, net income plus the interest expense, this is what I'm really giving to those two partners on the total assets they gave me, the total money to really buy all the total assets that I'm operating in the company. So how much money I'm actually generating for the total assets. That's a good number. The higher it is, that means on average, investors in this company are doing good. So I would like to see a company with a very high, the higher, the better. The second one, look at more specific at how much is really the profitability of the equity owners. And usually I look at the common stock versus preferred stock. I remove different type of stock as preferred stock. I didn't talk in this course about preferred stock. Maybe this is time to say a couple words. And again, I encourage you, go to the internet. There are excellent resources to fill up the things that I'm trying to avoid. Don't repeat myself as other people already have done, and focus on the special things that I have to contribute. So preferred stock in one word is they are preferred in the sense that if the company is profitable and the company is declaring dividend, they will be the first to get dividend. I repeat it. They are preferred in the sense that they will be the first to get dividend if the company is paying dividend in certain year. There are, by the way, some preferred accumulated preferred stock, meaning if the company doesn't distribute dividend in 1 year and skip a year, the following year, they are accumulating the dividend from the previous year. So this year, you cannot distribute dividend to the common stock, the regular stock, unless you pay the preferred stock for last year and this year. Okay? So this is why from the net income, which is available for the stock owners, we usually take the preferred dividend and subtract it. Whatever left, it's available for the regular stock, common stock. Okay? So we take the average value of the equity, not including preferred stock, and we take net income after subtracting the dividend we should pay for the preferred stock. That one is a good indicator. By the way, this is two ratios. They have something in common. Okay? If I looked, that ratio of return on equity, it's very comparable to the profitability of the debt owners. What the debt owners get, what the bank gets, they get interest. And we can calculate the profitability, it's already given. It's the interest rate we're paying the bank. If the bank charges 5%, we know that's their profitability. It's 5%. Okay? We definitely go in the corporate valuation, we distinguish between book value and market value in calculating yield or profitability or the real yield on a bonds. We distinguish between market value and book value. In this point, we're not doing it. We take the interest rate as an indicator. How much cost us to finance the company by taking a loan from the bank? If I take a loan and I pay 5%, how much do I pay the equity owners? Do I give them 10%? Do I give them 15%? If I give them 15%, should I really raise more debt? Because if I raise more debt, okay, it's cheaper. Moreover, on the interest, it's tax deductible. Okay, so all that comes into play, that now you see that this profitability ratio is really affected by also the decision in the debt ratio. The higher the debt ratio, okay, if the interest is lower than the return on equity, automatically it will allow, if the return on equity is higher than the interest, the higher the debt to equity, the higher will be even the return on equity. You can do this math. I won't get into that, and you can find a lot of places in the internet that's showing it. But it's true to say that the higher is the debt relative to the equity, as long as the return on equity is higher than the interest, then the company would like to raise more debt, because the more debt I will have, okay, I'm paying only smaller percentage than I have to pay to the equity. Therefore, I will have much more left to distribute to the equity owners. And that's what raise the return on equity. By the way, it's a very solid point. It's a very important point. Let's look at what happened in Apple. Let's see if that really plays a role in Apple's financial statement. Let's look at that. That would be really interesting. We already have said that Apple is financed by much more debt than used to be. We saw that total debt to the total equity went up. Okay, total debt to total equity went up. It's 2.5 times then, and it used to be really a fraction. That was really a small fraction. Now it's much higher than the equity. It's 2.5 times the equity. That means Apple becomes to be much more debt financed. How that affected the return, okay? How about that affected the return on assets? Wow, no surprise. Return on assets used to be 0.19, went to 0.21, 0.214. So if I look at the years up to 2017, you can say it was around 15, 17, up to 21%, okay? So let's say the average would be around, I would guess, it's around 17%, 18%. A big jump in 2018. Return on asset jumped to 35, to 34, 37 the next following 3 years. Okay, so we see that there is a relationship between debt to equity in Apple. Okay, the more they got to be debt financed, the higher becomes to be return on assets. No surprise, okay? But because they are paying less for the debt. If I pay less for the debt, I have more left. The government is taking less. The government is also taking less taxes. We'll look at the taxes in a second, okay? We don't have a ratio here talking about the taxes, but we will look at the taxes of Apple, okay? What happened to return on equity, which is another thing that we would like to see? That's very surprising. I would expect it to go up, but it didn't. It stays constant. Well, that might be alarming. You can say, why? But you can say it might be alarming. Why is it alarming? I would expect if the company becomes to be debt financed, it's more riskier. As a riskier company, I would expect the return on equity to be higher. Why is it alarming? Because who knows? Although Apple is a huge company, but if it will be a crash like the 2008, or God forbid, the Great Depression in 1929 in the US, maybe even Apple won't survive. We saw companies like Lehman Brothers didn't survive the 2008 crisis. Who knows? So increased debt for Apple did increase the total return on asset, but it did not increase return on equity. So on one hand, this looks a beautiful move by Apple, but is it a beautiful move from the equity owners? Okay, that's more to discover, and that's really why you should join us in the course of corporate valuation. I dive much deeper into it, but this is a good introductory course for that purpose. Okay, let's look at the taxes. By the way, let's look at the taxes. What happened to the taxes of Apple? Okay, let's look at the taxes. They used to pay 14 billion in 2012. Goes down, that jump up 1 year. Okay, we do see that 2015 their profit went up. Okay, so they paid a little bit more tax. But at the end of the day, if you look at the last 2 years, okay, relative to the first 2 years in this data set that we have for Apple, they're paying less taxes. okay? The revenue definitely went up substantially, almost doubled, okay? The gross margin went up by 1.5 times, almost really more, 1.6.7 times. We look at their EBIT, used to be 55. Wow, it's almost 3 times, okay? Still, their taxes relatively smaller than it used to be. That's pretty interesting. So really we can say, for finance point of view, really Apple have shifted their structure in such a way they're paying less taxes, they're paying more interest, by the way, you can see it immediately. They barely paid any interest in the first up to 2016, you can say, definitely up to 2015, and then they're paying a little bit, but now, wow, big amount of interest. They're paying a lot of interest. Okay? Still, you can see that net income, whatever they're paying to the equity owners, didn't change really substantially, but it really did. You say it went up, but the biggest part, it really goes to debt finance. So can we say, looking at that kind of what's happening in Apple, I pay more interest, I'm more debt financed, my revenue goes up substantially, but did it really generate more for the equity owners? It didn't generate more, but remember, if I'm more debt financed, maybe my equity is also lower. Let's look at the equity, okay? Is the total equity went down or up, okay, over the years? Let's look at the balance sheets. Let's look at the balance sheets again. Let's look at the total equity. Total equity used to be 118. Oh, I have much less equity. No surprise. I have less equity. And my income, if I look at the income, it did went up. So on one hand, the amount of equity is going down. My net income is going up, no surprise, okay? I have more left for the equity owners. But let's look at that again of the equity part, okay? How do we, which kind of an equity do I have? Do I have preferred stock? No, I don't have preferred stock. Retained earning, oh, hold a second. That's very interesting. I haven't seen the whole picture. And you know, as good as those ratios, and there's more to cover, okay? We have one more categories to go, and we talk about it, those ratios. But it's a good place to take a pause and look at a company like Apple. And don't just say, well, these ratios, and that's the end of the story. Dive in. And then, as I said, in corporate valuation, I dive in much more than that, okay? Because this is not the whole story. Look at the retained earning. Look at the retained earning. Look at the common stock. Common stock did go up. So in another word, probably the company have, well, not probably, definitely, they issued more stocks to the public. So they not just increased their debt, they also increased their issuing of stocks. So they raised money also by issuing stocks. So this increase of total sales from 176 billion to 323 billion, there were two resources. One, issuing more equity, issuing more equity on one hand. Okay, it's about 34, 33 billion, but mostly it's issuing a lot of debt. From 57, we jumped to 258. 200 billion was financed by taking more debt. So I took a lot more debt to finance the increase in the total assets. But that's not the whole story. Let's look at the retained earning of Apple. What happened in Apple retained earning? Well, used to be 101, it becomes to be only 14 billion. Wow, what does that mean? What is retained earning? Retained earning we defined in the first class. It's really the accumulated net income of the company minus any dividend I distributed to the company, to the shareholders. If I want to see how much dividend I most likely did, unless there's a special account, but it's really 99% or almost 100%. The difference between the 14 billion to the 45 billion means I have about 30 billion here. What is that 30 billion is? That means that in addition to the net income that the company have generated in 2020, all of that 30 billion gone as a dividend. But not only that, also the net income itself went and distributed as a dividend. Let's say if I have a dividend account here, okay? Let's say if I collected net dividend for Apple. This is all the data. Dividend, let's say dividend. Dividend should be on here. Dividend, okay? I say here 14 billion distributed as a dividend. 14 billion. They used to distribute only 2 billion as a dividend. By the way, this is really just one part of the dividend. And I need to check the numbers again, okay? But just for looking at the retained earning, the retained earning went down, okay? But the retained earning could be used for other things, okay? But it's another discussion. But just look at the dividend declared that we see in the financial statement. Apple is distributing more dividends. It's a change, you can tell. Definitely a change of policy between 2012, 2020. It makes a lot of sense. The company making a lot of profit, okay? So there we can see definitely the company is distributing more dividend, okay? Let's look at the other things that we see in the financial statements of Apple. Let's look at the equity one more time, okay? What about additional paid in capital? I don't have that number. Need to really check. That will be a good number to see because part of the retained earnings, okay, can be used when a company is issuing. So that number, I will give it to as an exercise for you, Brenda. Check on the additional paid in capital. We should pull that data also for Apple and give us a better picture because we see that from the retained earning, we could have distributed 30 billion, yet we saw the dividend was only 14 billion. So what is the difference? Okay, I really should look for the 30 billion plus the net income for the year. Let's look at the net income for the year. The net income for the year was no, here I'm looking on it. Let's look at the income statement. Net income was 57 billion. So 57 plus those 30 should really be explained. Where did they go? Okay, 30 plus 59 is almost 100 billion. And I see only 14 billion going as a dividend. So where is the difference going? And that's a very good exercise. We'll talk about it next session. I give it to you as an exercise. But let's try to pull the data for Apple. Okay, that's why pulling the data is such essential. As I said, this is a working process project, and we really should make sure that we put the data for Apple for a paid in capital, and that could shed light of what happened to the difference we just saw a second ago. But no question, just based on what we see here, the company is distributing more dividend. Company is very profitable, going from 41 to 57, still 57 billion, to a smaller amount, or percentage-wise, I should even say, of the equity, having a higher revenue. That means the profitability of the equity should go up, okay? And from the debt point of view, we see that a lot of the profit is going to really to the finance, the debt that we raised for Apple, okay? The more we will really perfect this program and collecting of the data, okay, the better picture we will. And I will visit Apple many times in the future, recording. And there's so much to say about this company beyond just talking about the applied in capital, okay? So let's move on to the next category of ratios, which is kind of ratios very popular, some of which be careful of, because they don't really tell you the whole picture, but yet everywhere, every website you will see those ratios. One of them is earning per share. You can ask, why do I really care? After all, the company can issue as many shares, or they can even have what is known as a split. If I give every shareholder another share, nothing really happened. It's just that I have more shares outstanding, so the earning per share will shrink to half, and nothing really happened. So earning per share by itself could be misleading unless you fix it and put it in the same denominator over the years. If you see and you just calculate the earning per share and don't account for split, which most of the time companies do, when you look at the Yahoo Finance reporting earning per share, they do account for split, like the example I just gave now. So, but if I want to compare one company to another one, okay, I should be very careful. If a company has the earning per share high, it doesn't mean they're more profitable. They just might be that they have less shares, okay? Return on equity could be comparable because I'm looking at the whole equity amount. Remember, return on equity, this is money divided by money. This is a percentage. Earning per share, okay, it is not percentage, is money. I take the net revenue, the net income, okay, and divide it by number of shares. So this is really dollar number. And that's one I cannot compare from one company to another company. I should be very careful, okay? I might compare the change in earning per share, assuming there was no split. That's good comparison. But just compare one company earning per share to another company, that will be misleading, okay? Be very careful. Again, unit is very important. Return on equity, it is taking money, net income, let's assume there's no dividend for preferred. So it will be net income most of the time, divided by the average equity. Average equity is really dollars. Net income is dollars. Dollars divided by dollars is a pure number. It is a percentage. That's why it's a return on equity. On the other hand, when you look at the earning per share, you're taking net income and you divide it by number of shares. What you get, it's dollar amount. How much dollars the shareholders receive that year? That's dollars. So when you compare one company to another one, be very careful. If one company has much more shares than the other one, be very careful. You can compare just earning per share to another company. So it's a very common to see that number everywhere, but be very careful. On the other hand, when you compare percentage change in earning per share to one company to another one, that's comparable, assuming there was no split or you accounted for the split. Okay? That's comparable because percentage change in earning per share, it's a pure number, it's percentage. Then you can compare one company to another one. Okay? Let's look at the next one. The other one is also should be careful. It's so common out there. P/E, that means market price per share. Pay attention. It's the first time in the whole series we're talking, this 5 sessions series so far. We never talked about market price. I talk about it a lot when I do corporate valuation. Market value, it's a very important, and to know when to use market value versus book value becomes to be so important, especially when you understand the theory behind doing valuation. But this is really one first time we're using it. Pay attention when we calculate price divided by earning per share. By the way, just as an exercise, and I will answer that anyway, okay? When I take market price per share divided by earning per share, do I get a pure number or do I get a dollar number? I get a pure number. The numerator is dollars. It's measured by dollars. Price is the amount that somebody just recently paid. Or let's say if I talk about 2020, end of 2020, this is the market value of, let's say if I talk about Apple, this is what Apple has people paid to pay the price of Apple. Okay, dividing it by the earning per share. Okay, this is also dollar amount. So dollar divided by dollar is a pure number. Can I compare this number one company to another company? You should be very careful because that doesn't tell the whole story. I might have two companies have exactly the same pure number, dollar divided by dollar, so it looks like comparable. But if I have one company that the price of the shares is $20 and they're making earning per share is $1, so the ratio will be 20. Again, market price 20 and the earning per share is 1. 20 divided by 1, it's 20. Another company has exactly the same price, $20 per share. But their profit per share or their earning per share is $2. Which company is better? Should I invest in the one that has 20 or the one that 20 divided by 2 is 10? Is the second company is better or the first company is better? Well, some company will say, well, maybe the other company, they're making a lot of earnings and they're undervalued. It's only cost me $10 to buy the share. Maybe I should run and buy that share. Wrong. Be careful. It doesn't tell the whole story. Okay? Maybe the first company is investing a lot of their earning in growth, and they might grow very fast relative to the second company. So maybe their earning now is very high, but they don't have any perspective for growth. So this earning P/E ratio does not take into account what is the expected growth from the company. And therefore, be really careful, okay? By the way, I talk about it again in my other course, corporate valuation. Some people can try to adjust, and there's another ratio which is not in the list here. It's called PEG, P/E, and some people try to adjust for what I just said now and divide by the expected growth of one company versus the other one, kind of then compare those two numbers. That's also is wrong, but that's not for this course, okay? And that's a whole discussion. Why you should be very careful when you account even for growth. Why you should be very careful when you compare price of earning of one company to another company. It doesn't tell the whole story, okay? Let's move to the third ratio. It's called dividend rate or dividend yield. In another word, you can say, bottom line, the company is distributing dividend. Some people even say, in the end, I really care only about dividend. There's a lot of discussion in the literature. Is that statement is correct or not? Is that true or not? Some people do believe that that's true. Okay, and there is some merit to that. Is really I care only dividend. If the company price, let's say the price of the shares is stable. And then really, if it was always the same price, okay, so really my yield is really the dividend. My return of what I'm really getting is really the dividend. But in many cases, the company is growing, and you really should account for that when you calculate the return. Again, it's a discussion for a different session. But for now, if I look only the dividend, cash dividend, divided by the market value, that's give me some indication if I'm getting enough return on my investment. I bought the stock of Apple at the beginning of the year. Apple gave me a lot of dividend. I'm happy. I only paid, let's say, $100. Okay, we can look it up. How much was the price of Apple in a second? And how much is really the annual cash I received? That can be really kind of indicator of the return of the, again, be careful. That doesn't tell the whole story, and you should be very careful. The next one is very interesting, by the way. It's how much out of the earning that the company have made per share, the company actually distributed to the shareholders. By the way, this should be really annual cash dividend per share, okay? So dividend, how much is the dividend as percentage of the earning per share? By the way, you can take the total dividend for the common stock if the number of shares didn't change and divide it by the total equity, and you'll get the total net income, and you get the same number because both of them you divide it by number of shares. Okay, so the number of shares really cancel out. Okay, so you get the dividend for the year, divide by the net income for the year, get you the same number. Okay, so this really just says how much the company is distributing. By the way, some company declared, Google one of which, declared we're not going to distribute dividend in the next following years. So I said, wow, my God, if this company is not giving me any dividend, why should I buy their stock? Okay, well, maybe as I said before, Google expecting such a huge growth, and instead of just raising more money by taking more debt or raising money by issuing more stocks, just simply says, we're keeping the money in the company. After all, it's going to belong to the equity owners. So the value of the equity will go up, and they know how to use that money much better than even the investor would use in other places. So they will say, well, we don't want to distribute any dividend just because we know how to use the money better. If the shareholders think the same way, then that's the right policy. And how the shareholders speak, it's by if the shares price goes up, then we know they definitely like that move of not distributing dividend. Okay? So it really is, you will see most of the time that if the company is more mature, okay, they most likely will distribute more dividend. It's a point in which the company is big enough and also already got to a point that they're kind of exhausted the places that can generate over return, I would say, okay? But that's not the rule for the companies and not even the rule for mature companies. Some mature companies, they can be there for many, many years until they get to that point, okay? But one indicator that investors usually like to see is the company distributing dividend and how much is as a percentage of the earnings of that year. The last one, which is a simple one, okay, it's just simple. How much is the book value of the share? If I take all the amount of the equity divided by the number of shares, I get a number. Based on the book, on the balance sheets, if I look at the balance sheets and I look at the total equity here is 178. Okay, or 877 in the last year in this example. Divided by the number of shares, that tells me, based on the accounting, what is the value of that share? That's what we call as a book value. But that doesn't have to be what is really being traded for. People in the stock market might pay even more than that. The more they pay for it, higher than the book value, you'll ask yourself, why? Why people are paying more than the book value? That's a very good question, which we addressed much more thoroughly in the series of corporate valuation. By the way, Tobin's Q, it's an index that economists like, and Tobin's have written a lot on that, and he's known. Tobin's got a Nobel Prize in economics, and he talks about that relationship between the book value to the market value. Remember, we use the market value right in here, market price per share. We also we don't have this ratio here, but you can easily edit Tobin's Q ratio. Already taking the market price divided by the book value. The book value is really nothing but what we think based on the accounting should be the value of the share. If the accounting is close to reality, then we'll expect this book value to be close to the market price. But as we know, those numbers don't necessarily equal. And as I mentioned before, Tobias have said there's a meaning to that difference. That might say that the company might have invested a lot in intangible assets, something that the accounting view them as expense and not as an asset. And maybe That difference between market value to the book value is due to the fact that this company's accounting is such that doesn't really reflect their true value, because whatever they're spending on generating know-how or they're generating more intangibles, the thing is like an expense. They don't realize that that can generate revenue in the future. And therefore, it really should be capitalized. Capitalized means no, don't show it as an expense. Don't reduce the equity. The equity didn't go down by the money I spend on intangibles. That's a huge discussion. Again, more thoroughly should be done than I'm just doing in this course. But it's a good introductory for you for first time. Okay? And please do follow our next series that we will do on corporate valuation. I go much deeper on those topics. It's a huge topics. All right, this really conclude those 5 categories of ratios. I didn't really jump to show those ones for Apple, and I'm not going to do for other companies because we haven't got to that point. So you have something to look for, and we will present those ratios more thoroughly in the future. Okay, you see, even for Apple, we didn't have the earnings per share, I didn't present it, and I didn't present even dividend payout ratio, and I need to add more ratios here, and we will, as I said. This is a work in progress project, and we will enhance it. We just started this project about a couple of months ago. We did a hell of a lot for such a young project. The hardest part was really collecting the data. And I will dedicate some point in today's session to talk about it, and we'll conclude by looking at another company. I think I promised on Amazon. So let's look at Amazon, and I will extend the discussion. What did we do to get to this point? Okay, so let's look at Amazon. Okay. By the way, you can, as I showed last time, you can log in and get into these applications through Academy City, and you can just choose one of those 20. We did so far about 20. We're perfecting the process of collecting data, making sure the calculations are correct before we open more companies to the public. So if we're making a mistake, so at least we're minimizing the risk. But it's quite good from those 20 we have done. Okay, let's look at Amazon. It's a very interesting company, no question about it. Let's look at the just clip and the balance sheet. Just look at the things. Look at that, their cash and cash equivalent, a huge jump. But before even I look at the cash, what happened to the total assets? By the way, I will look at that in the horizontal analysis. What we're really curious just to see, did the company blow? Yes, they did. They used to be 32 billion. Now it's a huge company, 10 times bigger. Amazon today, it's 10 times what it used to be 9 years ago. Amazing. A blow up. And Amazon is a huge company for many reasons. You know, they have several segments. It's all the discussion for this course. But as you know, they started selling books over the internet. Today, they are really so innovative in so many things. And Amazon now, web services is a big part of their business. So that began to be so good in really running online operation to providing those knowledge or this knowledge to other companies to use. I am hosting my Academy City website in Amazon Web Services. It's a very big source. So Amazon is 10 times bigger than it used to be. We'll see it in a second in the vertical and horizontal, but it's really interesting and curious just to see the numbers. And I advise you, look at the big picture. Look at those numbers. Look at them so you'll have a sense. What happened to the total liabilities? The total liabilities also went almost 10 times, a little less than 10. What about the equity? The equity is also 10 times. So I can say just from the little look, they're keeping the same proportion. And that would be obvious when we look at the ratios. We'll look at the vertical. What happened to the income statement? Curious. Look at the revenue, 61 billion. It's true the total assets went 10 times bigger, but no question, it really is today, it is 6 times bigger, more than 6 times, okay? It used to be 61 billion revenue, it is 386 billion today. It's a huge, huge jump. What happened to the revenue, to the gross margin? 10 times bigger. So you can tell immediately, this company really like 10 times bigger than it used to be 9 years ago. In any perspective, at least the glimpse that I just looked at the financial statement, I can say that and feel comfortable on saying it. Again, Brenda, Daniel, and all the others, Michael, we have to really make sure, I'm sure that a company like Amazon have research and development. That number should be there. We should make sure that we're putting the data correctly. So we need to explore more in our algorithm in collecting data. I will talk about it in a minute. And with that, we'll conclude the session for today on how do we approach collecting the data. And by the way, I will continue in the next sessions, talk about the technology we use and what we're actually doing those days. And we'll share with you as we go along, okay? But that's something we definitely need to check. And moreover, it's very common that a company like Amazon will have sales and marketing expense versus general and administrative. And we really should split those out. The truth of the matter is not a huge amount, okay, because usually when we don't see the sales and marketing, it's usually combined together. But it would be nice for a regular company to always divide those two. For Amazon, it might not be a big number, but others it is. By the way, it is a big number when you compare it to the operating income. It might be a small number relative to the revenue, but it is quite a big number relative to the operating income. And that comparison, it really does have an effect. So is Amazon spending a lot on marketing? I cannot know because I don't have the data. And that's why we have to perfect our data collections. And we will, okay? And make it available to everyone, okay? So that's really a glimpse. Let's look at the vertical analysis for Amazon, okay? We see cost of revenue, in fact, it used to be 75, went down to 60%, quite stable around the 60%, at least the last 3 years. Is that tells me efficiency? Definitely. I'm spending a smaller percentage of the revenue. And we know the revenue going up, but I'm keeping it around 60% than 70 or 75% it used to be 9 years ago. No questions, the company is more efficient. What about the gross margin? It's immediately translated to gross margin. I had about 25, 27% 9 years ago. Now I keep 40% as a gross margin. Very efficient in generating that revenue. A very good plus to Amazon, okay? You can explain that maybe because they moved to web services and are very efficient, and that can increase revenues just by the same resources. So their expense don't go linear with the revenue. And there's many to dive into to understand Amazon. But as a start analysis, that's a perfect point to notice. 40% out of the 100%. That's pretty cool. That changed from 20% to 40%. Immediately came up to here. What about the operating income? Again, from about 1%, okay, very close to 1-2%, to 6%, 5 to 6%, a huge jump. Amazon is, no questions, is profitable entity. And it's also in percentage-wise, percentage of the revenue. We'll look at those ratios in a second as well, okay? What about taxes? They barely pay any taxes, amazing. Huge company like Amazon don't pay taxes. By the way, if we go beyond accounting and finance, that could lead to some political issues for Amazon. I just think something that might. Look at what happened to Donald Trump during the election without getting to politics, but how much taxes he pays became to be an issue. Is how much taxes Amazon is paying going to be an issue? Could be. Is it something to put a question mark? Definitely is. Should I be concerned about it? Is a different question, and how much it should affect my decision to invest in the company or not. But no questions, just in looking in the vertical analysis, Amazon, although they are paying a little more taxes because it's 1%, but very small fraction, definitely not the statutory tax rate of corporate tax in the US. Okay? Net income from being close to zero, really, you can tell Amazon wasn't really profitable in those years. Just in the last few years, they became to be really profitable for the equity owners. They're making about 6% of the revenue. That's a big jump. And we'll see in a minute how that translated as a percentage of equity, at least relative to the book value. And we really should look at the ratios relative to the market value, as we talked about in the theory. Okay? So this is really give us a good glimpse on the company. Very simple vertical analysis. We can look at the horizontal. We won't be surprised seeing a big number in the revenue. We know the company is growing. The revenue grew 10 times. Every year, this company making about 20 to 25%. Last year, 37% growth in revenue. Amazing. That's why people love this company. That's why people come and invest in this company. Is it going to last forever? Who knows? Well, you can know much more when you dive into deeper analysis. But for now, no question is attracting attention. It's an interesting company. No question about it. Gross margin, it's about stable. You see, it used to be 30%, 42% in some years. But I can say 30% gross margin, pretty cool. Growth in the gross margin. Okay? That means more efficient. Don't forget, this is not the gross margin itself. This is the growth in the gross margin, in the gross margin. And this is efficiency. We talked about it before. Okay? And I will leave you the rest as an exercise based on our theory. And we'll talk about it in other sessions because I feel like this is getting a little too long. And I definitely will come back and talk about Amazon and Apple and give more companies and talk about it. I will just finish in a minute or two about what do we do to collect the data. What we do really, if you go to this website and you go to XBRL data, with the fact that the SEC required companies to file financial statement using XBRL. And we have expert on XBRL in our team. So if you click on 2020, it takes you immediately to the website of the SEC and for that year of that company. If you click on financial statements and you go to here and you click on, let's take the income statement or the balance sheet, consolidated balance sheet. I click on this one. You see the SEC give you the balance sheets already done. What we do, we have a very quick way to collect the data from this website, combine them together over the whole spectrum from 2012. If you have to do it yourself, you will have to go year by year and put it on Excel or something like that. But then you will have a lot of trouble and you will see there's so many troubles because the naming changes over the year. And then when you try to compare Apple to another company or Amazon to another company, the company is using different tags, and then you will have a trouble to compare them. So we unify them and make them under the same stable accounts. We use the same account. So when you look at something like this one, you look at cash and cash equivalent. Although here you will see cash and cash equivalent, okay? But the way the SEC allow companies to file, although the title cash and cash equivalent might stay the same over the years, but the XBRL, whoever knows XBRL know, you use text to represent cash and cash equivalent. And Amazon or Apple or any other companies we will show you in the future might use different tag for different years, and collections of data becomes to be almost impossible. So we found a way, a very fast way, and it's quite good, I would say, for 80–90% of data collections, and we're perfecting it over the time, and we will. So we'll be really close to 100%. And not only that, make it very quick comparison. So then in the end result, we're getting really the database, all the data we collected for so far, we'll add more accounts, and we make sure that there will be, all of them will be filled, or at least if the company is reporting for it, they will be filled. So that's really what the special things that we finally got to in this series. So that's really why we work so hard. We prepared you, we talked about accounting, we talked about financial statement analysis, but really the biggest contribution of Academy City to this field is helping in the area of technology. How do we use XBRL and how do we use it to collect data? And that's going to be the topic for the next few sessions we continue this series. If you have questions, please do feel free, leave a comment below. If you like our video, please put a like, send us comment. We would like to perfect our videos. And if you have any suggestions to perfect our really relatively new project, and will blow up, it will be blown up. Okay, you will see there's a whole staff of corporate valuation we do here. We talk huge amount of time on risk premium. By the way, you see it's very slow now, but we perfect the speed of risk premium. Okay, and you will see in the future. I'm not going to show you the here, and all of that coming in the next series on corporate valuation. Okay, thank you guys, and hope to see you in other sessions. If anybody has questions, this is the time before we conclude. Any questions? Brenda, Daniel, Michael? As all our videos are very condensed, we try to put out what we special in and not just repeat what other people has done already, have done. So if anybody have a question, Daniel, Michael, anybody? Okay, otherwise, thank you guys, and we'll see you in the next session.
Okay.